So have you ever really stopped to think about what it means to own a piece of a company? We hear about owning stock all the time, but what does that little slice of paper or, digital certificate actually represent? Well, today we're going to slice right into that question and get a handle on stockholder equity. It all starts with this question. Who really owns the company? I mean, think about it. A business needs cash, maybe millions, for some huge new project. They have to get that money from somewhere, and the choice they make about how to get it, well, that changes everything. It determines who's really pulling the strings. And that choice brings us right here, to stockholder equity. All it is really is the total value that belongs to the people holding those slices we talked about. You could call it the true net worth of a corporation. It's what would be left for the owners if the company had a massive garage sale, sold off everything it owned, and then paid back every single person it owed money to.
So, when a company needs cash, it basically has two roads it can go down. The first is debt. You can think of this like getting a loan from a bank. You have to pay it back, and you have to pay interest. The other road is equity. This is where the company decides to sell off permanent little slices of itself to investors for cash. It's this constant trade-off. Do we borrow money, or do we give up a piece of the control?
Okay, so this brings up a pretty practical question, right? If you go and buy one of those slices, how do you know how much of the company you actually own? Let's do a super quick and easy calculation to figure out just how big your slice of that pie really is. First, let's start with the whole pie. Imagine our company has put a total of 100,000 shares out there into the world. That number, 100,000, represents 100% of the ownership that's up for grabs.
And now, let's say you, being the smart investor you are, decide to buy 20,000 of those shares. That is your personal stake, your piece of the business.
In the math, it really is this simple. You take your 20,000 shares, divide it by the total 100,000 shares, and boom, you own 20% of the company. And that's a big deal. It means you've got a claim on 20% of every single dollar of profit and every asset the company has. But here's where things get a little more interesting. Not all of those slices of the ownership pie are baked the same way. So let's dig into the different kinds of stock, because believe me, each one comes with its own unique set of rules and rewards. First up, we've got something called preferred stock. Honestly, the easiest way to think about this is as the VIP slice of the company. It comes with some really nice perks.
So what exactly makes it a VIP slice? Well, as you can see, preferred stockholders are always first in line. If the company pays out profits, called dividends, they get their check before anyone else. And if things go south and the company has to shut down, they get their original investment back first. So what's the catch? The big trade-off is they usually don't get a vote in how the company is run.
Now let's talk about the one you've probably heard of. This is common stock. And if preferred stock is the VIP slice, we can call this one the voter slice. This is, by a long shot, the most, common type of ownership out there, and its main feature is all about power. Common stockholders have voting rights. That means they get a say in big company decisions, like who sits on the board of directors. But all that power comes with a pretty big risk. If the company goes under, they are the absolute last people in line to get paid. Okay, now for a kind of weird one, treasury stock. These are just shares that the company itself has bought back from the public. But wait, why would a company buy its own stock? It's all about strategy. Sometimes they do it to boost the value of the shares that are left, or, and this is a big one, to tighten their grip on control and fend off a potential takeover. All right, additional paid-in capital. It sounds super technical, but the idea is actually pretty simple. Most stocks have an official starting price. Let's just say it's $1. But if investors are excited and willing to pay $10 a share for it, that extra $9 is what we call additional paid-in capital. It's really just a measure of how much confidence the market has in a company right out of the gate.
Now this might be the most powerful part of a company's equity: retained earnings. This is all the profit the company has piled up over the years that it didn't pay out to its owners. Think of it as the company's giant savings account, or its war chest. They use it to fund new projects, buy other companies, and just generally fuel their growth. For a lot of investors, a big pile of retained earnings is a great sign of a healthy, smart business.
Okay, pop quiz time. Let's put this to the test. Imagine a company is shutting down for good. After it pays all its bills to the banks, its employees, everyone, there's just a little bit of cash left over. Looking at this list, who gets that money first? And the answer is B, the preferred stockholders. If you got that, nice work. That preferred title isn't just a fancy name.
It's a real guarantee that they are at the front of the line to get their money back way before a common stockholder would ever see a penny.
So, with all these different pieces, common stock, preferred stock, retained earnings, all of it, how in the world does anybody keep track of it all? Well, that's where this really important financial document comes into play, the Statement of Stockholder Equity.
So why should you care about this one statement? Because it's basically the report card for the owners. It doesn't just give you a snapshot of one moment, it tells you a story over time. It shows you if the company is actually making its owners wealthier or if the value of their pie is slowly shrinking. It's the ultimate scorecard for how well a company is managing its owners' money.
And that leaves us with this final, fundamental tension that's at the very heart of owning a company. Do you take the profits and reinvest them to make the entire pie bigger for everyone in the future, or do you take a bigger slice for yourself right now by paying out those profits? A growing pie or a bigger slice? That is the question that every owner and every manager has to wrestle with every single day.